Welcome to Making Money Matter, ladies and gentlemen. I'm your host, Kerry Stevenson. Today, I've asked Charlie Morris to join me all the way over there from England. He's the founder and chairman of Bytetree.com, B-Y-T-E-T-R-E, Bytetree.com, which is an investment research, data, and asset management business. And for me, he's also a former Army guy, Sandhurst man. And as a naval girl, I thought that was pretty good. And you write a lot. You write the Atlas Pulse on gold. But what fascinated me is you've got this new product it's an ETF called Bold, ladies and gentlemen. Now, many of you will know that back in 2018, I was doing something on gold and Bitcoin and the potential for those two to combine in such a way. Now, that's what I want to talk to Charlie about today. But he's got a background in banking and funds management, HSBC. He's been in the markets a long time. He's seen a lot. So we're going to delve into a few things today. But Charlie, great to see you. Thanks so much for joining me all the way over there from England. How is it over there?
It's a pleasure to be here. I'm looking forward to this.
Well, first up, because this is the first time that you've joined us on the program, tell us a little bit about Bytetree.com, what it's all about.
Well, it's primarily a research hub, and we've got some different publications. And I joined HSBC Asset Management, or James Capel as it was called then.
Oh wow!
In 1998. And back in those days, you came into the room and there were loads and loads of brokers having conversations with their clients about what was going on in the market and what stocks to look at and all. And it was a buzzing atmosphere. And as you roll the years forward, we went into this discretionary world, and the advisory broking stopped. Execution only went online, and the room was silent. Within about 10 years, the room was silent. Wow. And sort of clicking of keyboards. And I thought, well, how do you sort of bring that excitement back and distance yourself from just 60-40 portfolios and index funds and go back to proper stockbroking, which is what we do. So we recommend undervalued companies, mainly pan-European, bit of America. We'll do emerging markets typically by ETF, that sort of thing. Maybe closed-ended funds as well. And we've got a sort of low-risk portfolio which is called Soda. We've got a medium equity risk portfolio called Whiskey, and then we've got mid-small cap service called Venture. And we also do a bit of crypto as well. But if people want to see what we do for free, they can read our gold work, Atlas Pulse, and they can read our Bitcoin work, Atomic, absolutely free on Bytetree.com. But that's what we do. And then there's a product we have called Bold, as you mentioned, which is an ETF listed in Switzerland. We'll get to that.
Yeah, absolutely. We'll get to listed in Switzerland. Did not know that. What changes? Because you just mentioned there that you were back in the day, 1998, with James Capel. I remember those days, Charlie. And you said it's changed. So in that 10 years, it went from a real buzzy to just the click of the keyboards and stuff, and almost taken the soul out of it. How do you see the markets at the moment? That sort of big picture overview, because right now, as I talk to you, coming up towards the end of April, we've got some geopolitical tension around the world. I believe you've just been to Uzbekistan. What are you seeing? Because what I'm sitting here thinking, I'm confused. Inflation's not transitory, seems to be pretty sticky. The world seems to be in a bit of a state at the moment. What's Charlie's view on what's going on? Because I think that's important for investors to understand.
Yeah, I mean, I would say that the risks are heightened, but they have been pretty persistently for quite a long time. They're always changing, but I would say that the world view, where white Anglo-Saxons rule the world, is ending. And has ended. And I don't just mean white Anglo-Saxons. I mean developed emerging, that sort of crossover, and the military angle to that. And of course, Australia is very much a part of that. America's obviously been in charge, but I just think that view of the world is tired. And I don't think that the Third World War thesis is probably with us quite yet, but the risks of it have certainly increased. And I think that, you go to someone like Uzbekistan, where I was last week, as you rightly said, and they're neutral. They're former member of the Soviet Union. They got independence in 91, and they are just neutral. Right. And that is fair enough from their perspective. And I think we were all a bit too shocked. We were a bit shocked 2 years ago as a society when people didn't rally around Ukraine in the way that our politicians thought they would.
Hmm.
And so that is the change. Lots and lots of good countries, respectable countries, friends of ours, are neutral. And that just tells you that there are different views. And there is some sort of split in the system. China, I mean, I went in a car last week. I sat in this car made by a company called Li, L-I. I'd never been in it before. It looked like a Range Rover from the outside, sort of thing, but inside it was just stunning. I mean, it had lovely seats, but then the dashboard was like a spaceship. It just had computers all over the place. Not just one iPad, but just tons of this stuff, and sort of models of the road and where the cars were, and it was, I hadn't seen such a high tech car in my life. And I thought, and Janet Yellen has just been over to America, to China, to basically say, stop putting cheap, amazing cars on our doorstep.
Oh, really?
Yeah. And then, you look back at the Huawei phone ban and you wonder how much of that was spying and how much of that was protectionist,
Mm.
because the
Mm.
Huawei phone was really cheap,
Yep.
and really good. And so we are in this sort of strange old world where they get criticized for, so we're trying to go green, and then they dump all these dirt cheap, amazing solar panels on our doorstep, and they get
Hmm.
criticized.
Hmm.
So which is it? Is it capitalism? If so, what what version of capitalism? What's changed from the old days when we used to appreciate cheap, good products? So something's really, really changed spectacularly, and the system of money is broken from so many different angles, mainly because there's just been too much issuance of debt over the years,
Hmm.
and we're not doing anything to combat that. There's not a single politician that even mentions it. We carry on with these whopping great big deficits. If you wanted to fix it, you just squeeze the system. You'd stop
Go back to
printing,
a gold standard.
yeah, I mean, you wouldn't actually even have to do that. You just have to have fiscal discipline for 20 years. You could do
Oh,
it.
yeah.
There's just no will to do it. I mean, anywhere.
There's no
And
votes in fiscal discipline.
there aren't. And so that's why we're going down this route. And I think that gold is back as the barometer of monetary trouble. And Bitcoin's the upstart. It's new, it's younger. It's not new, actually. It's 15 years old. There's nothing new about 15 years old. But I guess compared to 5,000, that is new. But it's only been on the scene for the last few years in a proper way. Where you've had sort of credible exchanges. I mean, 10 years ago, it was very much a model railway of the economic system. The little bank and a little exchange and this sort of thing.
Yeah.
A hobbyist. But now it is pretty serious as a monetary asset. But the beauty of Bitcoin is it's different from gold. So they're not in competition. I think that Bitcoin is the gold of the internet, and gold is the gold of the real world. And
That's
they're not in
interesting.
competition.
When you say they're not in competition, I sometimes look at Bitcoin versus gold. I look at it quite a lot. And it appears to me that there's that sort of younger generation, that tech savvy generation, understand Bitcoin and the fact that it has certain qualities that they quite like. But a lot of it is, to be honest, a lot of them are speculating. And that's what they like to do. Whereas gold appears to be more of the sort of the older generation. Do you see it like that, or what's your view?
Well, I consider myself older generation and like both, so not exclusively, but I think as a generalization, that is correct. I mean, generally speaking, younger people look to the digital and older people look to the metal. But I've met lots of people who are old who like Bitcoin, and I've met lots of people who are young who like gold. So I think that it's probably a fashionable state of affairs at the moment. But I think just because that's the case today doesn't mean that's the case in 10 years' time. I think that people are bored of gold, or until recently, because it hadn't done anything for a long time. And I would argue that in 2011 it probably went too high. Went to 1900, probably shouldn't have gone much past 1400. And so
Okay.
you had to unwind an overbought situation, which took a decade. And but it's back, and gold is on its way higher. And you tend to find there's a non-correlation between Bitcoin and gold. Certainly a very low correlation, and that very simply means that when Bitcoin's going up, gold's probably not necessarily going down, but not doing much,
Not
and
doing
vice
much,
versa.
yeah. Yeah.
Yeah. And so didn't we have in the last couple of weeks, we've seen a bit of a sell-off in Bitcoin in the run up to halving,
Hmm.
and gold's been well bid in that time. And you can see years like that. 2014, Bitcoin collapsed, gold was stable. 2013, gold collapsed, Bitcoin surged. 2018, Bitcoin collapsed, gold surged, or towards the end of the year anyway. And we just keep having these periods where one offsets the other. It's very natural. And I think some of the explanation is that gold is very naturally a risk-off asset, and Bitcoin unashamedly has always correlated with internet stocks. So it's internet money. It's part of the FANG thing. It's part of the Amazon, Apple, Nvidia. It's all part of that club.
And being part of that club, do you think that, we talk gold, we talk Bitcoin, we talk investing. Do you think in these days of such changes and things being a little bit unsteady, it's a good time to be diversified? And I want to get into the Bold ETF a little bit further down the track and how it actually works. But for now, I just want to find out, because we have a large audience of investors, and a lot of them say, well, why should I bother with gold? I just want to go with my tech stocks. But I always think that you should look at things and say, if you're diversified, if one's going up and the other one's a bit wobbly, then your portfolio's better balanced. What would you say?
Well, I think people have forgotten what a tech bear market looks like.
Mm-hmm.
And 2001, 2002 was
Shocker.
brutal. It was an 80%er for big stocks.
Yep.
The biggest stock in the FTSE in 2000 was Vodafone, making up 15% of the weight. And that stock went down by 80% or something. Nokia was the same. Ericsson was the same. Nortel in Canada. All of them. And then all the dot-coms, many of which went down 99% and never to recover.
Yeah.
So, a proper tech bear market is brutal. Now, we did have one in 2022. So we did see a lot of the speculative stocks go down a lot. And the good ones with cash flow are recovering. The lesser ones aren't. But the big stocks this time, the big stocks are just horrendously overvalued. And I think you can make a case that it's very 1972 in that sense, because you had the Nifty 50 in the States, which just became very, very large, must-own stocks. These things are taking over the world. And there's nothing wrong with the companies, it's the valuations.
Yes.
And if you measure the valuations of the big stocks, they're just horrendous. They don't make any sense. It's impossible to imagine that Apple will ever be a good investment in a generation, because it's priced for perfection and doesn't even grow. Stop growing.
Do you think that it's some of these stocks that are, what you say, a bit overvalued, or potentially a lot overvalued, are just because that's where the attention is and everyone's talking them up, but they're not actually really understanding the fundamentals, and people are really, it's very much a social media world that we live in now, and people go, oh, look, it's all about the tech stocks. And so people that don't do their homework pop their hard-earned money into those stocks, which just keeps building up and building up until it doesn't.
So, Kerry, I couldn't get through a whole talk with you without blaming some regulators. And I think they very much, there's been this huge focus on cost. And so everyone loves the ETFs because they're very cheap, and they just sort of track the market, which means they've got lots of money in the bigger stocks. And go back to that room at James Capel in the late 90s, where everyone was having a conversation about what was interesting and what was cheap and what was good. That conversation died. And so, and the market went to ETFs. So the concentration of money in these few big names really has got out of hand. And we've seen it in history. We've seen it in 1929. We've seen it in 1972. We've seen it in 1999, and we know what happened next. So you've got this extraordinary situation where too much money is concentrated, leaving a lot of value on the table. So if you go back to good old-fashioned stock picking, pick up Benjamin Graham's book, The Intelligent Investor, or whatever, written nearly the best part of a century ago. I mean, that will work. It's going to work in the next 10 years, and it's in a very, very good way. And that's it, really. I mean, I think it's just so much passive money have distorted the market and just left tons and tons of stuff behind. In our country, everyone's sort of running around in Britain complaining why the British stock market's broken. But a large part of it is just the fact that we've lost free markets globally, and there's been excess concentration of money going into the American market, which in turn has kept on boosting these big stocks. So it's a sort of circular argument, and at some point it breaks.
Yeah, and I guess that's kind of what I'm trying to tease out of you, if you like, Charlie, and that is, are we on the cusp of something breaking? Is that partly why you're focusing a little bit on gold, or do you see gold as the place to be at the moment, while some of these overvalued stocks would not be the place to be? Because I don't know what it's going to take, but we could get back to something like it. I don't think we're ever going to get to a 1929, but we could see a bit of a pullback.
Yeah, I mean, it depends what breaks. You know, I mean, the 2029, the bond market was fine. It was a safe haven. So if you switched to bonds, you were absolutely fine. But this time, bonds are the problem because of the inflation that's coming through. And of course, inflation doesn't just send the price of bonds down because interest rates go up. So that means yields have to go up, which means prices have to come down. So that also rotates onto stocks as well. So if you're a highly valued stock, then that's not good to have higher rates of inflation. And indeed, the PE ratio, or the valuation that we should pay for growth stocks, should come down in an inflationary environment. And if you think about an internet company with a as close to 100% margin as you can possibly imagine, I mean, it's hard to get a business model that's any closer. You obviously can't have a margin above 100%. And what do internet companies make? Well, they make money. They don't make anything physical. They just make money. And if the value of money is going down,
Mm-hmm.
then what they make is less valuable than it was before.
Yeah.
So you'd pay more for a high growth internet stock in a low inflation environment than you would in a high inflation environment. So if you went to Turkey, if a country like Turkey with high inflation, very high inflation, launched an internet stock that was growing even faster than the rate of inflation, you wouldn't give it the credence that you would to a similar company in Switzerland when the inflation is very low.
Do you think inflation's because there was talk earlier this year about, there'll be rate cuts. They were talking about 3 rate cuts over in the US. They were certainly talking rate cuts here in Australia. It seems it's not really being spoken about. It's like, if we don't speak about it, it'll go away. Rate cuts, no rate cuts, inflation here to stay. What's Charlie think?
Well, if we get rate cuts, I think it will be a panic situation, like it normally is. I don't think we're going to get them. I don't think we're going to get calm rate cuts.
Okay.
I think we're more likely to have emergency rate cuts if things go wrong. But it's very difficult for a central bank whose only asset is credibility at the end of the day. I mean, they print money, which all that, but their real asset is their credibility. And if the credibility says, well, the inflation target's 2%, and they can't get it to 2%, and they start cutting beforehand, well, what does that mean for the inflation target? And so they've been very open in recent years compared to what they were in the past, where Greenspan would famously say, "If you think you've understood me," so if you think you understand what's going on, then you clearly misunderstood me, was one of his great quotes. It was along those lines. But they made a joke about the fact that they just talk and not say anything, and they used to have wonderful use of language and so forth. But it's we may see the rate cuts come through, but I just doubt it, because I don't think the inflation is going to come down nearly as quickly as everyone says. I mean, we called the pre-COVID, pre-pandemic era a sort of disinflationary period, but basically inflation was 2%, and we're different from that. So it can't be 2%; it must be higher, which means it's 3% or 4%. And by the way, you can value gold on a TIPS model, which is well known in the gold market, but you can take a 20-year TIPS price and you have a strong correlation until the last 2 years, and that correlation is broken down. And people say, oh, something's changed. Well, maybe it hasn't changed. Maybe what's changed is that the TIPS model is not accurately pricing TIPS. And that could mean...
Explain that to us, if you could. Talk to me like I'm a 5-year-old for everyone.
Sure. So you've got a thing called inflation expectations. So if I buy a government bond in Australia or America, whatever, I get the return of 4% a year or something. Yeah, the capital moves about because that's what markets do, but the income is what it says it is. Now I can buy an inflation-linked bond, which is going to give me a predefined amount of income.
Yep.
And it's going to give me inflation. So if inflation's 4, 3, whatever, and my income's 1, then I'll get 4, 5, something like that.
Yep.
So whatever inflation is, you're protected. If inflation is low, you'll get a lower payout. It doesn't matter because it's inflation protected. And if inflation is high, then you'll get a much higher payout. But it'll be the same amount of real value in either case. Now, if inflation-linked bonds are underpriced because for whatever reason people aren't buying them because they believe that inflation is going to 2%, so they've all sold them. And if you look at the fund flows in the bond ETFs, they've all dumped in the last 2 years,
Right.
inflation-linked bond, and they
Right.
bought conventional bonds. Excuse me, because they believe that the 2% target is going to be met.
Okay.
And so it could be that we're getting this extraordinary false signal for future inflation expectations, which are coming out at about 2.3% over the next 10, 20 years, per year.
Okay.
If that's wrong, and you say, okay, what would the gold price be if inflation over the next 20 years was 4%?
Yep.
It would be rather similar to what it currently is. So in other words, if you believe gold is the real tips model,
Right.
and tips are giving you the false signal, it could be that gold is telling you that inflation over the next 20 years is going to be 4% rather than 2.
Yes, because at the moment gold is doing the inverse to what it would normally do. I mean, stocks are on the up, bonds are relatively okay, yet gold has been going parabolic. What are you putting that down to at the moment? Because I have to say, Charlie, when you start to see mainstream media covering the gold price, not just a cursory comment, but interviews with people and, whoa, what's happening with the gold price? And suddenly people are asking questions. We potentially are at a very interesting crossroads.
Yeah. Well, I think the first explanation is one I just gave. Gold is more accurately than other inflation predictors telling you where we're going. But I also think there's another one, which is the money supply argument. There's just more and more money in the world, but someone's always printing. It might not be America at the moment, but there are back channels where we're getting liquidity coming through. I mean, if we were shrinking the money supply like we read it, the stock market wouldn't be as punchy it is right now.
Yeah.
It would be much softer. So there must be money coming to the system, and there's been printing in China and places like that. So globally, there's still money supply growth, and I think that if you were Uzbekistan or similar 2 years ago, you'd happily own US Treasuries. Now you won't. So if your reserves, they've increased, the typical central bank has increased the weight of gold over treasuries in
Yeah,
their basket.
absolutely.
So you've got a structural demand, which has offset the selling from normal investors. Now, investors, for some reason, have been selling gold in recent years. And it's still a bit of a mystery why. But they've sold $70 billion worth of gold
Because they got
since
bored.
2050.
They got bored with that. You know what I reckon it is? I reckon it was the barbecue mafia standing around saying, "Oh, you own gold. Oh, I'm in the tech stocks. Oh, I've made 50%, 80%, 100%." And the poor old gold holders were crying in their beer and saying, "Well, I'll sell all my gold and go into tech stocks."
Yeah, I'm sure there's some of that. But of course, one of the old arguments was always, own some gold in your portfolio and hope it goes down, because that means everything else goes up.
Correct.
And
Yeah.
and so maybe there's a bit of marketing spin about that, but I think there is some truth in it. And right now you've got this situation where people don't even bother paying for insurance, despite valuations of the big stocks being totally out of control. So it's a very odd time for investors to be selling gold. But it means that the average portfolio in the wealth management industry around the world, or pension fund, is underweight gold. So you've now got a bit. You've got the central banks buying it now, but then over time, and as things start to go wrong, the wealth industry is coming back, and it's going to underpin this market for a long period of time. And the same is true with Bitcoin, by the way, because individuals own Bitcoin, but governments don't, and institutional investors don't. So, or not much. And so basically there's a strong long-term bid on both assets as all that money, starts to say, oh, maybe it's time to own some alternative assets again. What are Bitcoin and gold? They are alternative assets. Bonds and shares pay yields. They fiddle around in fiat. They're in the Aussie dollar or the pound or the dollar. That's what they do. They're productive businesses. Bitcoin and gold are alternative assets that don't pay an income. And what's special about them is they're liquid alternative assets. So
Right.
what's another alternative asset? A second-hand car. So in high inflation countries like Argentina, second-hand cars are a store of value. In Germany, in the hyperinflation back in the 20s, grand pianos.
Oh.
Yeah. So these are all, and we know art is well known, but anything that's sort of a piece of beauty and limited supply, and they don't roll off the production line like a grand piano or a painting or whatever. These things are good stores of value, but they're not liquid. You
True.
can't trade
Yeah.
these things in big size. So, but gold and Bitcoin, you can. Gold's nearly as liquid as the S&P 500, and Bitcoin's, doing its best to catch up. But it's more liquid than silver, for example.
But
So,
why, sorry, Charlie, for interrupting you, but I want to understand this because so many people I speak, they don't understand gold. They don't know even how to get started. They don't understand Bitcoin. They do understand what you and I call the fiat currencies, which is, Aussie dollar or US dollar. They understand the bits on the screen. They understand tap, tap, taparoo on their phone, but they don't understand gold should be, gold is money, everything else is credit. Why do you think that is? Is it because the fiat in currencies are just so big and so widely used?
yeah, so they're growing. The supply of fiat is growing. Let's call it a trend rate of 7% a year of the
Wow.
G20 countries.
Wow.
And which we're talking numbers, sort of 70 billion a year or something. And sorry, 7 trillion a year, 7 trillion, because 100 trillion, so it's 7 trillion a year is the trend rate of growth. And then you've got gold supply growing at 2% a year, and Bitcoin supply as of halving 0.8% per year. So, balance the seesaw.
Yeah. 100%. Okay. Do you what I'd like to get to is, do you think now is the time people need to set up and start taking some notice of gold and Bitcoin, like get educated?
Yes, I think, excuse me.
Bless you.
Thank you.
That's it, ladies and gentlemen. That's Uzbekistan. Not blaming Uzbekistan, but planes, trains, automobiles.
Yeah.
Poor Charlie. I grabbed him just as he got off the plane, pretty much. But
yeah. People should be educated on these things, and I'm not going to tell people to buy Bitcoin or buy gold. I mean, that's up to them. But
yeah, totally.
But I do think that they have a long-term place in a portfolio. If you look at any study of, should I add gold to a standard 60% equity, 40% bond portfolio? Should I add gold? And every statistical study over a long period of time says yes, you should.
Right.
And the answer is 5 to 8% in gold. And you'd probably take that out of bonds. And then if you do the same exercise with Bitcoin, you could very easily make a 2% allocation, because it's very volatile. So you'd want to reduce your size of that. And of course, if Bitcoin does go to the moon and to $1 million, you don't actually need that much if it's going to do so well. So, but I'm not really in that camp that think it's charging to $1 million in a heartbeat. I think I've got a more sober view of Bitcoin, but I do think it's a very serious real asset. I do think it is real, but I'm just not as bullish as the crazy people who think it's going to the moon.
Good. That's good to know. I want to talk about Bold ETF before we run out of time, because the Bold ETF is something which really reweights, from what I understand, it reweights between gold and Bitcoin, which I found fascinating. Talk to us about, why did you come up with this idea, and why should people even be looking at Bold? I think it's fascinating.
Good. Well, let's hope the audience find it fascinating. In the late 90s, I came across gold. Obviously, I knew what it was from a, mum's wedding ring, sort of thing. But as an asset, I went to a presentation with Tocqueville, and in 1999, I mean, everyone was talking about the internet, and gold was 250 an ounce, and no one cared, and there were no products you could buy, or there was one fund called the Golden General Fund, and which did mining shares, and that was very small. So it really was an uninvestable asset class for most people, and it really wasn't taken seriously. And then that was the low. The high is when the news is great. Yeah, of course. Everything's perfect, and the situation couldn't be better. That's the top. Couldn't be worse. That's the bottom. So 1999 was the bottom, and then Australia were the first country in the world to launch the gold ETF in early 2003, and London got one later that year. New York the following year, and it all started to go very well, and then people started to find a role for it in portfolios. And still to this day, we've got a couple of $100 billion in portfolios. So when I say that people have been selling, yeah, but there's still a decent chunk of gold globally spread across portfolios, and that's a good thing. And for me, Bitcoin was a sort of 2013 discovery. Someone had told me about it in 2012. I said, "Don't be ridiculous. You can't have internet money. You can cut and paste it." Yeah. Once I realized you couldn't cut and paste it, then I fell in love with it and thought, wow, that's amazing. And you know, I wasn't always sure that Bitcoin would be the winner. I sort of thought maybe there's an AOL type thing here where, you know, the early internet companies faded quickly and were surpassed. And, you know, Google wasn't young, wasn't original, nor was Facebook. None of these things were at the front of it. They came later and ended up winning. So I kind of assumed that that would be repeated in some way. But actually, Bitcoin just stayed there as the dominant piece, and really is the only proper alternative asset, because all the others have gone down the proof of stake route, such as sort of most of the others like Ethereum and stuff, which are kind of somewhat controlled by a board, and, you know, the governments can intervene, whereas Bitcoin truly can't. Let's not dig into that too much. But so I sort of ended up with these two wonderful things, Bitcoin and gold, and thought to myself that these should go together, because I'd have written about gold for 25 years and Bitcoin for 10 or 11. And I thought, you know, it's so obvious these things have a low correlation. And so, you know, one's going up, the other's not. And so if you can keep owning these two things and then rebalance the strategy on a regular basis, which we do monthly, then you're just maintaining the risk of your product. So if you don't rebalance, for example, Bitcoin could go from 10 to 100, you know, and then suddenly your portfolio's got hardly any gold in it because there's a tiny little amount. It's not, so you're no longer balanced. So think of gold being the sort of, in our ship, it's the ballast, and Bitcoin sort of being the spinnaker, and it's sort of driving us forward. It's a bit like that. And then the next question was, okay, how much Bitcoin, how much gold? And the first thought would be 50-50. But if you do that, then you realize that in terms of risk, which is the way I like to think about things in portfolios, you've actually got way more risk in Bitcoin than you have in gold. So how can we make that the same? And by a tiny bit of maths that's published on our website that we do every the last day of the month, which takes probably a 7-year-old could probably do that with a calculator in about 20 seconds. So it's not complicated. It's a very simple bit of known financial maths. And to risk weight, to put the same amount of risk in each asset, you end up at the moment with around 25% in Bitcoin and around 75% in gold. And every month you keep coming back to that risk weight, which is always changing very slightly. So one month it's 25, then it's 25.3, and then the next month it's 24.9. It's not moving around a lot. But basically, if Bitcoin wants to go back to being really volatile, that weight's coming down over the next few years. And it could go down to 10. And if Bitcoin wants to grow up and become less volatile, then the weight is going up slowly over the years. Yeah. And gold's the counterbalance to that. So what it means is if I got $25 in Bitcoin and $75 in gold, my probability, my chance of losing $5 or making $5 in each asset is the same.
So if for the, you know, somebody watching right now that might want to get involved with what you're doing and says, I don't really understand gold or Bitcoin, but here's a guy that does his research that's going to keep rebalancing it. Is it liquid? In other words, I want to put, is there a minimum amount that they can invest? Can they do it from Australia or anywhere in the world? Tell us a little bit more about the parameters of getting involved.
Well, I don't know what the situation is in Australia with access to products in Switzerland. It's Switzerland and Germany and Netherlands and France has got listings in different countries and different currencies.
Right. Okay, so that's where it's listed, is it? So Switzerland, France,
Switzerland, Germany, France, Netherlands. Tickers bold, BOLD.
And what was the reason for listing them there?
Well, they're banned. Crypto products are banned in the United Kingdom.
Oh, I didn't know that.
Yeah.
Really?
So I've had to go abroad. So Australia's got a Bitcoin ETF, but the UK regulator still banned them and doubled down the other day. So we've just been allowed in Hong Kong. Obviously, they're huge in America. They're free in most of the EU, and Switzerland and Brazil and Canada have all got them, and Dubai have got listings. So there's lots of space that have listings. And the United Kingdom is the odd one out here, where our regulator has said no.
On the grounds of what? Because that's the something that other people say to me. What if governments just turn around and ban any use of Bitcoin?
Well, they haven't banned Bitcoin. They've banned Bitcoin ETFs.
Right.
So they've made it difficult. So basically, most people have got much more money in their 401k in America or SIP in England or whatever we call it in Australia, your pension pot, right? And most people have got some sort of access to financial services via an online broker or something. Yeah. If you want to buy Bitcoin, traditionally, you go through an online exchange, and the bank would always make it difficult to do. You want to transfer $10,000 to a crypto exchange. That's always been made quite difficult to do. Your bank
And it gets more difficult. Yeah.
And gets more difficult. And so they just wanted to keep it difficult. So they're saying, fine, go and buy Bitcoin online using a thing where you'll get a bad reputation with your bank and that sort of thing. And then the ETFs just make it all legitimate and easy.
Yeah.
And of course they weren't banned before October 2020. There was a huge Bitcoin ETF trading scene here in the UK pre-2020, and they
So what
banned it
happened in 2020? Why
on the
did
6th of October. They announced the ban, which was implemented in the 6th of January 21, but they never given a reason why. You know, I can assume it just means that, you know, some technocrat would have said, it's a Ponzi scheme, we're going to save everyone.
Yeah,
and of
100%.
course the price of Bitcoin was 60k, and it's now, sorry, it was 10k, it's now 65k. So they're just embarrassingly offside. And we also, this coincided with the Prime Minister, our Prime Minister saying he wanted the United Kingdom to be a crypto hub.
Then he bans
and then
it.
the regulators banning it. So, why is my product in Switzerland? Well, there you go.
Yeah. Oh boy. Okay, and they can find out more about it on your website as well. Look, I just Bytetree, BYTETREE.com. Bytetree.com is where you'll find all of Charlie's research. It's free, so go and have a look. And he's got the Atlas Pulse gold track record as well. So I think he shows on there, and I think at the moment it's in the green. It's a bit bullish, but he'll show you all the times when he was when he downgraded, when he upgraded. So it's quite fascinating. So you can do a lot of research around this as well, ladies and gentlemen. I think it's important. So Charlie, last comments go to you. First of all, where can they find you apart from Bytetree.com? Are you on Twitter?
Well, that's easy.
Oh,
sorry. Yeah,
are you
easiest place to start. We're crossing each other. The other place is on Twitter. I'm at Atlas Pulse, Atlas as in map, and Pulse as in that. LinkedIn, Charlie Morris Bytetree, you'll find me. And probably that's it. I'm not sure where else. No doubt somewhere else on the internet.
Well, I think I'll keep them busy enough on your website anyway. Final comments go to you. There's an investor audience out there having a look at this and thinking, don't know where to go. What would you say to wrap this all up, Charlie?
Yeah, so I think that, you know, there was a comment the other day I answered. Someone said, is gold sort of overdone it? And my answer is, well, if you think that the governments are going to start becoming fiscally prudent, then yes. But if you don't think governments are going to be fiscally prudent, then no. This is a long-term, steady gold bull market. Bitcoin's going to be a crazier, wackier one that's going to overtake and then undertake from time to time. Make the most of that by a rebalancing strategy, keep your risk down. And that's what the Bold Index does. Go to our website, do it yourself for free. If you're able to and want to buy our product, you can. You don't have to. You can implement this strategy for nothing. Or however you do it. And I think you should. I think you should at least go and look at it, because it is a fascinating idea. And I think it just sort of reawakens gold. It brings gold to life, and it calms down Bitcoin.
Brings gold to life, calms down Bitcoin. That's exactly what we want, ladies and gentlemen. Charlie, really good to chat to you. Let's get you back on again in the not too distant future. But for now, thanks so much for joining me on Making Money Matter.
Thank you very much.